Also, don't forget to go to the podcast at Apple Podcasts, iHeartRadio, and Spotify. Leave us a comment and a review. It's called the Retire Young Podcast. If you're just tuning in, Al was shedding some light on what's going on with supply and demand and price action on charts. How the financial markets work is based off supply and demand. It's where the institutions or the smart money, we're going to call the institutions smart money today, where they're buying, but also where they're selling. And there's a disconnect between the institutions or the smart money and the public. So he's getting into different concepts and techniques on that the institutions use that are also available to us. So Al, as we get into this segment, we have a lot of listeners that want to understand how the smart money is creating income. Now, let's talk about, everybody knows the stock market. So let's talk about that first, because people think, you mentioned in the first segment, buy and hold. It's just
right.
Really, it's just with no plan of gain or loss. Now, there's ways that the smart money is creating income with the stock market every single day. Let's talk about those different concepts and different techniques that those smart money creates income with the stock market.
Right. Well, the stock market is one asset that people have access to. And for long-term investors, for people that are looking at building up an account to retire on, the stock market is probably the best vehicle for that, probably the best vehicle ever created that everybody has an opportunity to participate in. But when we're talking about the necessity of having assets for a shorter-term situation, then that long-term portfolio really isn't going to be of value there. That really is for those later years when you retire. That's when you want to have something there that you can rely on. But let me talk about that buy and hold strategy again, because that's what most people are put into, even though when the institutions are not trading long-term. They're looking at creating a cash supply right now, because they have a bottom line that they have to achieve for their investors and for their clients. Well, the buy and hold strategy is really long-term, yet that's what almost everybody is put into, regardless of whether their goals are long-term or short-term. And think about it. If that buy and hold, if that was the best way to take advantage of the financial markets, why don't the institutions do that with all of their money?
It's one of those things, do as I say and not as I do, isn't it?
Correct. Yeah. Do what they're doing, not what they're saying. And a lot of people have seen.
But just think about that. They're doing something totally different than the public, or what they're doing for the public.
Right.
And who's always making money? The institutions, no matter what. The public are typically struggling.
Yeah, well, you mentioned the word disconnect before, and the disconnect really results in a significant difference in the returns that the public achieves compared to the institutions. And that's why a lot of students are coming into our center, because they want to understand how to bridge the gap between that disconnect.
Really find out what they're doing.
Yeah, but you've probably seen the movie Trading Places.
I have.
A lot
Great
of
movie.
people,
Dan Aykroyd.
Well, yeah, but you see what happened on the trading floor, how the pandemonium there. And a lot of you listening probably have seen clips of what the trading floor used to look like in these pits. But it was like pandemonium. It was like a mini world war, where people were yelling and pushing and using these hand signals, but they were doing that throughout the day. If buy and hold was so great, what they would do is just put together a portfolio and then they'd let it ride for decades. So instead of all this pandemonium on the trading floor, they'd just be standing around playing games on their phone.
Boy, that would be a boring movie.
Well, it wouldn't make for a good movie, that's correct. But, maybe, just maybe, they're seeing some financial benefits on a regular basis, not just on a decade-long basis. And that's what our students want to understand, too. How do they take advantage of the markets on a shorter-term basis? If you'd like to know what they're doing and what they're using, these are the things that we go over in these classes that Josh has been talking about. But here's the key is to understand what's available and what is available to you as individual, the public, individual non-professional traders and investors. And basically, it's the same thing as the institutions are using.
Okay, so we covered the stock market. Now, there's other assets that they use, including the stock market,
Correct.
Right? Let's talk about those real quick.
Yeah, there's other assets they use, including the stock market, and in addition to the stock market, or use with the stock market to boost returns. And we kind of categorize them as leveraged assets. We're talking about the futures market, the foreign exchange market, which is commonly called the Forex market, the options market. And the great thing about leverage is that It's for people that have limited funds. Brokers allow a smaller account size with the potential for larger opportunities. And then people that have a large portfolio that maybe want that preserved, leverage gives them the ability to allow for a smaller portion of that portfolio to potentially create larger opportunities. It's like a carpenter. I think you used to kind of be in the construction
I was in the trades
business
for a long time.
Yeah. Do you just have one tool? Do you have do you pound nails with a saw?
Well, this is a family show, and I had one tool, and it was a hammer.
Yeah. And do you cut wood with a hammer?
Sometimes you do, but
Yeah.
but correct. You do not. You have more than one tool.
Yeah. And what I'm getting at is that there's a proper tool for a particular job in construction, and the same thing is true in the markets.
Maybe there's a reason I'm not in the trades anymore.
That's true. You hung up your hammer,
Yeah.
or somebody took it away from you.
Pretty much.
And that is true. There are assets and strategies that can be used in up markets. There are assets and strategies that can be used in down markets and in sideways moving markets. And the markets go through all three directions. It's not a one direction kind of a situation.
You're right, Al. There's so many different opportunities that us as investors or the general public just don't even know that's available. The smart money knows that's available, and these different techniques and these different concepts, especially for these multiple markets, whether it's up, down, and sideways. I mean, that way you're not losing opportunity, because that's one of the things people don't like missing out on. That's that FOMO, is opportunity. Right. So if you want to have more opportunity and learn more about these, how the smart money utilizes the stock market in up and down markets, Al, we just kind of tickled just the tip of the iceberg right here, and we want to get into these other markets now. The futures and the forex market, what are they? You mentioned the forex market. That's that's currencies, but let's explain what the futures market is so our listeners can understand. Okay, these other assets are also available.
Right. Well, in addition to having leverage, and when we're talking about leverage, what we mean is just increasing the buying power of every dollar that you have. That's one of the reasons that the smart money uses leverage. With the futures market, for example, maybe you get a 20-to-1 leverage where every dollar controls $20 worth of an asset. That can change. The futures market is made up of a number of different things. And this is one of the great things about that market, is that it is probably the best market for true diversification that there is. You're looking at the major stock markets. And basically what you're doing is looking at what something will be worth in the future, either more than it is now or less than it is now. And you can take advantage of either direction. But we're looking at the major stock markets, the Dow, the NASDAQ, the S&P 500, the Russell, some foreign markets, commodities. And this is a lot of futures traders trade commodities. In fact, a lot of our students were maybe farmers, and that's what they have been doing just to protect the value or the profit on their crops.
Yeah, think about this now. We talk to a lot of people, and people want to trade stock because, I know what Apple stock is. I know what Microsoft is. I know what Netflix is. It's just because they feel more comfortable because they know that.
Sure.
And they say, futures, I don't know that. Well, if you don't know oil, if you don't know the S&P 500, if you don't know what gold is, I mean, we should talk. But everybody knows those things, so that's why you can be comfortable. It's just something a little bit different.
Correct. It's knowledge. It's understanding what something is and how it works, why it works a certain way. It's knowledge, and then also the development or the building of the skills to use that knowledge. And I mentioned the major stock markets and commodities. You mentioned oil. What about precious metals, gold, silver? People know what gold is. Currencies, interest rates. There are a number of different things there. You can have multiple futures holdings that are totally diversified. In other words, the movement of one has nothing to do with the movement of another. Corn, for example, the corn market doesn't care what the S&P 500 is doing. So you can have that true diversification, and it's open almost 24 hours a day, which gives a lot of versatility there, because a lot of people that are working during the 6.5 hours that the stock market is open don't feel that they have a great opportunity to participate there.
Now, think about that. It's a good hedge as well, because if the stock market is going down, they can, investors, even the smart money, they're doing this. You can hedge your portfolio, because if the stock market goes down, gold potentially could be going up, silver potentially could be going up. So there's inverse correlations. Now, you mentioned something a little earlier I want to get into. You said something about You can take advantage as you can buy at a low price, and as it goes up, you can take advantage of that. You can also sell at a high price and take advantage of it as it goes down. It's called shorting. Explain that a little more, what that really means, because that may be a new concept to a lot of listeners.
Right. Well, shorting in general is making money or having the opportunity to have a profit in a downward moving market or in an asset that's going down, basically by selling something you don't own. You borrow it from a broker, from the broker's vault, so to speak, sell it, and then since you have sold it, you borrowed it, you have an obligation to return it. So your goal is to sell it at a higher price and then buy it back at a lower price. The difference between the high price you sold it for, the low price you bought it back for, is your profit.
Yeah, and that sounds like a little complicated, and people think it is, but just remember, trading is electronic.
Yeah.
And people can sell to open first and then buy to close. It's just opening and closing. So as profits go down, that's where the profit happens.
Yeah.
As prices go down, just like as prices go up, profit happens there. It's the same thing. It's just backwards.
Yeah, and we go into a little more detail on that in these classes. But the concept of shorting, sometimes that's not available. In fact, for example, if a broker doesn't have shares of a stock to loan you, you can't short. In the 2008 recession, the SEC halted shorting for a while. But the futures and Forex, those are contracts. You can sell those. You're essentially doing the same thing as shorting, but it eliminates what could be a potential downside to shorting. So you can do that. You can go long a futures or Forex contract. You can go short a futures or Forex contract. And a lot of institutions did that in 2008 when they couldn't short the market. So there's some opportunities regardless of which direction the market's going. You get the versatility, and that leverage is huge. A 20 to 1, maybe as much as 100 to 1. With Forex, the foreign exchange market, where you're looking at the difference in exchange rates between currencies or interest rates, the leverage is 50 to 1. That gives a lot of people an opportunity to participate, but they're afraid of it because they just don't know what they are, and that's where education comes in. It's not really any different or more complicated than the stock market once you learn how these assets function.
Yeah, that's crazy. Some of those stock prices are just getting out of hand, and that's, think about this. The average investor can use, or us, we can use leverage. We can utilize a 24-hour market. I mean, a lot of people work during the day, so there's opportunities in the evening. Just think about all these opportunities. Also, you're mentioning shorting. There's opportunities in up, and there's opportunities in down markets. And if you want to learn more about these other asset classes, the futures market, the Forex market, also don't forget to go to the podcast at Apple Podcasts, iHeartRadio, and Spotify. Leave us a comment and a review. It's called the Retire Young Podcast. Now, coming up in this next segment, Al, I want to continue this discussion with these leveraged asset classes. We haven't covered options yet. A lot of people have heard of options, but a lot of the smart money, they're using options in their retirement accounts because we talked about these ridiculously high prices in stock. Well, let's use some leverage there. This is Josh and Al with the Retire Young radio show. We will be right back.